Welcome to another episode of Mortgages Made Simple. I'm John Thomas with Primary Residential Mortgage, here to explain another topic for you. So today's topic is the fully indexed rate. What the heck is that when you're talking about an adjustable rate mortgage? So an adjustable rate mortgage, also called an ARM, when you get that, you get it fixed for a certain period of time, and that's called your initial teaser rate. And what happens is at the end of that time period, let's say you got a 5-year ARM, at the end of the 5-year fixed period, your rate is then going to adjust, and it will continue to adjust throughout the term based on the type of loan you got. So once you get into that adjustment period, the rate that you're actually paying on your mortgage is called the fully indexed rate. So the fully indexed rate consists of two things. It's a combination of the margin that your lender got you when you got the loan, plus the index at the time of the adjustment that your loan is based on. So basically, again, your fully indexed rate, which is your mortgage rate you're going to make your payment on that time, equals the index plus the margin. So when we look at that, if you started out at 4% index and your margin's 2%, your fully indexed rate, which you're going to make your payments on, is 6%. Now, at the next adjustment period, if the fully indexed rate, or if the index that your loan is based on is now risen to 7%, your margin can never change, so your margin would still be 2%. So now your total interest rate is 9%. So the fully indexed rate moved up from 6 to 9% at the adjustment because the index changed. Now if you go and the index drops, let's say the index dropped to 3%, well, your margin stays at 2%, well, then your fully indexed rate would then be only 5%. So during the adjustment period of your loan, every time it readjusts, your fully indexed rate is a combination of the margin plus your index. So let's look at another example. Let's say you've got a 30-year adjustable rate mortgage that was 6% on a 5-year ARM. What this means is that your mortgage is fixed for the first 5 years at an interest rate of 6%. At the end of the 5 years, your loan is now going to enter its adjustment period, and it will adjust. So your fully indexed rate at the end of 5 years is going to change based on the margin in the index. So the index, let's say you got a 5-year ARM that was based on what's called the LIBOR index, which is a commonly used index in mortgages. And the margin, let's say, was determined by your lender, the margin was 2%. So your fully indexed rate on that one would be the 2% plus the margin of 2% would be 4%. So in this case, as long as there's no caps on adjustment, your interest rate at the end of the adjustment period, or at the beginning of the adjustment period, would change from 6%, drop down to 4%. Now, if there was what's called a 1% cap, then the fully indexed rate should drop to 4, but it's capped, it will only drop to 5. And then the next adjustment period of adjusting every year after that, they would recalculate it. So if it was still 4%, then it would drop again from 5 to 4. So caps keep your adjustment from having big swings. So your fully indexed rate is basically what you're paying throughout the adjustment period, every adjustment based on the index and the margin added together. Hope that was helpful. Look forward to seeing you on the next episode of the Mortgage Education Update.